Welcome to our Accounting with Excel workshop. In this video, I'm going to work my way through the tutorial. Watching the video isn't sufficient. You'll need to do the work so that you're practiced in how to do this for the tute and for the quiz.
Let's start with loan repayments. It's really important to set out your raw data clearly. This is how I do it, and I encourage you to do something similar. So my data is coming from the tute sheet that you're using also. We have a home loan for $250,000. So let's enter that as the principal. I should spell it right. We make monthly repayments, so we're going to enter that as 12 repayments. Which is the number of months per year. The term of the loan is 25 years. And the interest rate is 7% per annum, which means per year. We're going to use the PMT formula to work out what our repayments will be. That's exactly what the PMT formula does. So start off by entering equals PMT. Then in brackets, we'll enter the rate, the number of periods, and the present value. Now, this is where it gets a little tricky. Our interest rate is 7% per annum, but we need it to be per month. So we need to divide our interest rate by the repayments. The N per is the number of periods for the entire loan. Well, the loan goes for 25 years with 12 payments per year. So we multiply the term by the repayments. And the present value is our principal. You'll notice that once again, I've not put any numbers in the formula, only references to the raw data. And press enter. This is our result. Excel really lends itself to data modeling, and we are able to look at how different aspects of the loan will change the payments. We're going to change the term of the loan. We'll make a drop-down menu for the term. First, we'll write a list of the options. We'll put it over here, 10, 15, 20, 25, and 30. We'll want our drop-down menu to appear in the term box. So let's click there. We'll go to the data ribbon, I'm already on it, and click this icon here, the data validation button. Where it says allow any value, choose list. And for our source, we'll choose the list that we prepared earlier. OK, and you're done. You can see that you can select the options for the term from our drop-down menu. We can now calculate the total cost of the loan. We'll put in a total repayments heading. We're going to multiply the total number of payments, which is the term, by repayments by the cost of each repayment. And that gives you this. I forgot to point this out earlier, but the repayment value is negative because it is money leaving your bank account. Because it is a negative number, when we add the total repayments to our initial principal, we can see the total cost of our loan. We can see that if we change the term of the loan, our total cost changes. Now, let's work out how much we can borrow. Once again, from the cheat sheet, our income is $50,000 per year. We have a $10,000 expense for candy and alcohol, and we have $20,000 for food and petrol. Let's calculate our net income. It's our income minus our expenses. We can now put in our interest, which is 3% per annum. Our repayments are quarterly, so we'll enter 4. Quarterly is 4 times per year. Our term this time is 20 years. If we're spending all of our net income on our repayments, then $20,000 is all that we can spend. We'll use the PV formula, which calculates the present value of the money that we're paying over time. The PV formula asks for the rate, the number of periods, and the payment value. Once again, there are some hidden tricks. The interest that we have is an annual interest rate, so we need to divide it by the repayments. The N per is the total number of payments, which is the term multiplied by the repayments. The PMT is the amount of the payment. Remember that if we're spending all of our net income on the loan, then we have $20,000 to spend. And we must enter that as a negative value because it is leaving our bank account. But also, we need to divide it by the number of repayments because this is all the money that we have this year. We need to spread it across all of the repayments. Close the brackets, press enter, and we're done. This is the most expensive house that we can afford to buy in today's market. Interest rates change, so I've made the interest rate into a drop-down menu. I think you can do that now. I'm going to quickly show you how to use VLOOKUP to make your spreadsheet a bit more user-friendly. Firstly, here in our repayment cell, we have a 4, but we want it to be more intuitive and say quarterly. But all of our formulae are pointing at this 4. B10. Well, let's move the 4. You can see that if we move the 4 like that, the other formulae update for the new position of the 4. Now, we need a list for our drop-down menu. Here's one that I prepared earlier. You'll see I've put in 2 columns. One for the name of the repayment frequency and one for how many payments per year. VLOOKUP won't work like this. It needs the first column to be sorted. So let's sort the table. Let's make a drop-down list in the repayment cell that has all of the name of the repayment frequencies. And in our number cell, we're going to do a VLOOKUP. Start with VLOOKUP equals VLOOKUP. What we want is the value that we're looking up. And we're going to look up the value in our repayment cell. This one. That one. Then we tell it where to look, which is in our new table. And finally, we tell it in which column in the table to get the answer from. So we have column 1 and column 2. Our answer is in column 2. Close the brackets and enter, and you can now use the drop-down menu to change the number of payments. Now, I've created a new sheet for how much we need to save. I've recorded the $50,000 that we want to save, the $1,000 that we currently have. We're moving in 3 years, so that's our term, and we're making fortnightly payments every 2 weeks, so our number is 26. We're going to use the PMT formula, the one from the start of the workshop, but we're going to use it a bit differently. There are all the usual tricks plus one more. So start with equals PMT. And our rate is interest divided by repayments. Our NPER is repayments times term. Our present value is minus 1,000. This time it's important to record it as a negative number. And the future value is 50,000. Close the brackets, enter, and you're done. This is how much you'll have to put away every fortnight to end up with $50,000 in 3 years' time, starting with $1,000. Another clever thing that Excel can do is work stuff out for us. One of its powerful tools is called Solver. Solver may be available under the analysis section of the data ribbon. If it's not, go File, Options, Add-ins. Down the bottom, there is a Manage drop-down menu. Choose Excel Add-ins and press Go. Tick Solver Add-in. Okay. There's Solver there. On a Mac, go to Tools, Excel Add-ins, then choose Solver. We can use Solver to work out what the input should be for a certain objective. We want our objective to be minus $500. We will change the savings, interest, and term to see what we need to do for us to be able to afford the repayments. Solver needs to work on a completed formula. So I'm going to copy our existing information over to the 3 new columns. Okay, now let's start Solver. Our objective needs to be our current formula result. We're going to tell it that we want to achieve a value of minus 500. by changing the amount of savings that we have. Press solve. Okay, solver found a solution. Okay. And you can see that it works out that we need to start with this much money if we're going to save $500 a fortnight and get $50,000 in 3 years' time. And that's all there is to it. Excel can do a lot more things and a lot more powerful things, but this is enough for you to get a taste. It really helps to practice this stuff, so make sure you're familiar with it all before you start working on the test.